Hey everyone, welcome to another edition of Hilton Insights. This is our monthly program that basically keeps you up to date on really important things that are going on in the markets or really important things that related to your money and how it's going to affect the efficiency of you building wealth. So, on behalf of Jay Bradley Hilton and myself, I'm excited to have another edition of Hilton Insights. And today, we're going to talk about a very important topic and something that a lot of people don't think about enough. When you look at smart money investors, and if you remember, we've talked about this a lot, smart money is really the people on Wall Street, the people that are running the money systems all around the world. Those people have a certain way to invest that is vastly different than, say, the average retail investor that's paying way too many fees and they're very focused on returns. That's all it's about. Today, I'm going to talk about how the truly wealthy focus on safety and security a lot more than you would think. So, as a retail investor, an average investor, most people will pick investments first and foremost based on the rate of return that they receive. And that is a mistake. So you might notice that if you've ever had mutual funds, the way that they're sold is by the 1, 3, 5, 10-year performance. So you think about it, people, the vast majority of people actually pick mutual funds just from that. So, well, if we can get this average rate of return over time, then that's a good mutual fund. The reality is that the retail side and those on Wall Street want you to think that way because then it excites you, it kind of triggers kind of the greed factor, and then people flock to an investment if it say shows for like the last 3 years it's made this type of return. So on the smart money side, first and foremost, what those folks are focusing on is safety and security. How is my money most protected? What's the volatility of this particular investment? And they just know that the returns are going to be there, especially kind of in the world they invest in. So at Hilton Tax and Wealth Advisors, that is our first and foremost thing we do. We try to build portfolios that have a great safety, you might say, foundation, and then we can go from there to then build full portfolios. The returns are just going to be there, but we want a solid foundation. Now, I want to tell you a little bit of a story. This is interesting. So years ago, Berkshire Hathaway went into a conference room in Wall Street of this big hotshot company that was making, 20, 30% per year for their clients. And actually, Warren Buffett attended the meeting. Normally, he wouldn't attend meetings like this, but he got a special invitation. He knew the people that were running the firm. And the first person that got up was kind of this hotshot young guy that started talking about all these fantastic returns. And if Berkshire Hathaway invests in it, it's going to just, blow up the Berkshire Hathaway portfolio. It's going to make things so much better because of all the returns, the returns, the returns, and the returns. Well, Warren Buffett sat there and listened throughout the whole thing, but he was squirming in his seat the whole time. And at the end of this young guy's presentation, he said, "Young man, I understand the returns you're going to get us, but how are you going to protect our money?" And there was just this long pause, and all the partners that were there from this firm, they didn't have anything to talk about related to how the money would be protected and even the volatility of the money. So, of course, Warren Buffett and his team got up and walked out of the boardroom, and that firm lost out on a huge opportunity. So, the point here is that a lot of people think that even somebody like Warren Buffett, they're making a lot of money and staying on the Forbes 100 list by these incredible returns, and maybe they're taking a lot of risk and all that. The reality is most wealthy people's portfolio, maybe 50, 60, sometimes 70% of it is very safe and very secure. And then they're taking a portion of their money and putting it in other ventures, other types of investments that can still get great returns for the rest of the portfolio. But if something really goes wrong with one or two of those investments, or something even wrong in the economy, then that can ruin their entire portfolio, and for many of these people, their entire legacy. So, the lesson here that is super important for us to understand is, first and foremost, focus on safety, and the rest will happen over time. But if you focus on safety first, have a great foundation for the portfolio, it's kind of going to be the rock long term that builds that legacy and builds your wealth over time. So hopefully that's some great information for you today. We're going to continue to do the Hilton Insights on a monthly basis and hopefully give you some really actionable, good information. So thank you so much for listening today. I hope you've gotten some great information. For further information, go to the link in our bio, and you could also order our latest book, Hilton Wealth, How to Invest Like an American Dynasty, and we'll send that to you complimentary.